Well, we really had a continuation of the pattern of the first quarter trend. It was a pretty benign environment, low levels of volatility, risk assets generally doing well, equities outperforming bonds, but all assets, nearly all assets, producing decent positive returns. And extraordinarily, if we look back over the past 12 months now, equity markets have returned something like 20%, despite what has clearly been a pretty challenging sort of political environment, if nothing else, in that period of time. So surprisingly good returns, including in this second quarter of the year. Without question, the key fundamental factor driving markets, both in the second quarter and through the first half of the year, has been a pickup in economic growth globally. It's the first synchronized global pickup we've had since the financial crisis 8 or 9 years ago. The US has been growing at around 2.5%, but we've seen Europe sort of mired in almost recessionary conditions since the crisis. It's now growing at about a 2% rate, quite a significant pickup. Japan has also grown pretty well. The UK, which people thought would fall into recession post the Brexit referendum a year ago, has actually continued to grow quite nicely at about 2%. All of that growth in developed markets has sort of rolled over into the emerging world, which has also grown well. China, second biggest economy in the world, has grown at about 6.5% to 7%. So all in all, decent global growth. And intriguingly, that's been achieved whilst keeping inflation levels pretty low. There's lots of slack still in the European economy because of this long period of very sluggish growth. In the US and the UK, where unemployment levels have fallen to historically low levels, surprisingly, that's not sort of caused an uptick in wages, which would normally then flow through to inflation. So in those two economies, inflation has remained very subdued. In fact, one of the surprises, I think, of recent months is that core levels of inflation have actually come down a bit. So that has enabled central banks to maintain a very loose monetary policy. There's no great signs of inflationary surges. There's no excess credit, with the exception probably of only China. And central banks have been able to maintain very loose monetary policy, very low interest rates at a time when economies are growing. That clearly has helped the corporate profit sector. We've seen corporate profits picking up at double-digit rates in the US and now in Europe and Japan. So very good environment, pushing equities, while developed equity markets up 4% in the quarter, emerging markets up 6%. And because of this low inflationary environment, bond markets have also produced positive returns. So really ideal conditions for markets. Two of the more surprising moves in the quarter were definitely in commodities and currencies. The oil price, such a key part of the global economy, of course, fell actually quite sharply from the peak of 2 or 3 months back. The oil price has now slipped 20%. And the problem here is one of supply. It's not a demand issue, it's one of too much supply. OPEC reacted to that 6 months or so ago by cutting production by close to 2 million barrels a day. But that hasn't had the effect that they wanted. And the main reason for that is that US shale oil production has increased by close to 900,000 barrels a day over the course of the past 6 or 8 months. And that's because the cost of production have been brought down so dramatically. OPEC has now extended those production cuts for a further 9 months until March next year. But the oil price has not actually reacted to that to date. In fact, it's still pretty weak. Not a bad thing at all for the global economy, given the fact that it helps to keep inflation low, sort of acts like a tax cut to consumers. So I'd see that as a positive development. Second surprise, actually this year, not just in this quarter, has been weakness in the dollar. I guess going into this year, most people thought the dollar would be strong. In the event, it's actually fallen on a trade-weighted basis by about 7%. And the euro, the second biggest currency in the world, has actually been much stronger than people thought. The economy's done better, the politics have gone better. So the euro this year has picked up by about 7 or 8% against the dollar. A weak dollar, as long as it's on a sort of controlled basis, is not a bad thing for the global economy. Indeed, if anything, it helps emerging markets who borrow so much in dollars. So both of those developments, although a bit of a surprise, I'd see as a positive. Although politics wasn't, I don't think, the driving force behind markets, that was definitely the economy, it certainly helps to explain some of the trends that we saw. For instance, that weakness in the dollar, I think, is a reflection of the fact that the so-called Trump reflation trade, when everybody thought that his big policy initiatives, tax cuts, regulatory reforms, infrastructure spending, that would all help to boost growth. That has largely unwound, and it's unwound because he's just not been able to implement any of those policies. He had several setbacks, and of course he faces the political reality of this, what he called the Washington swamp. Very difficult to get stuff done. So that has definitely been a factor, and everything we hear about his sort of presidential position is it's pretty chaotic. The administration is in chaos. So it's not a great sort of situation for the most important economy and country in the world. In contrast, politics in Europe, which looked pretty dicey going into this year, with several big general elections where anti-EU, anti-Euro parties were polling pretty substantially, they've gone the way of the sort of centrist, moderate politicians. The far right has been rejected in the Netherlands, been rejected, more importantly, in France, the second biggest economy in the EU now that the UK is coming out. And we now have in France, importantly, a young, energetic, unproven politician, but with a clear agenda for reform and absolutely pro-EU, pro-Euro. He recognises he needs to reform the EU for it to survive in the longer term, but it's a move in the right direction. So politics in Europe has definitely moved significantly in the right direction and has helped this euro. Remember, a year ago when the UK voted to come out of the EU, there was a real risk of, in time, the EU falling apart. That's now been kicked right into the long grass. In contrast, the UK took a serious step backwards politically. The decision of Theresa May to call a general election, thinking she'd win an enhanced majority, clearly went badly wrong. Wholly inept campaign. We now know the situation. Hung Parliament, very difficult to sustain sort of unity across the Tory party. Definitely weakened the authority of the government. Weakened the UK's position in its Brexit negotiations, which have now started. It's cast a doubt over the government's ability to maintain tight fiscal policy, and it's led potentially to a far left, sort of almost Marxist government under Jeremy Corbyn if the general election is called anytime soon. So, catastrophic decision by Theresa May, bad for the UK, and no surprise that UK assets were amongst the poorer performers in the past couple of months as a result of all of that, and likely to remain under a cloud because of this deep political uncertainty that now prevails in the UK. Markets have done well this year. Global equities up 10%, emerging markets up 17%, bonds, credit in particular, has done well, sort of low to mid-single digit returns. And probably all those returns better than people anticipated going into this year. But importantly, that has been supported by improving and good fundamentals. So I don't think we should be overly concerned that markets have become overheated at this stage. But there are risks out there. There's too much debt around. Debt levels globally are about 40% higher than they were at the time of the financial crisis. China's got a particular problem of a credit boom that's got to unwind whilst maintaining growth at levels which are socially and politically acceptable. You've had this rise of populism and nationalism in recent years, which does pose some risk to the global political and economic order. I wouldn't overplay that, but it remains a concern. And then most important, you've got the beginnings of the unwinding of ultra-loose monetary policy. So these huge amounts of liquidity, these very low interest rates that have been very supportive for risk assets for the past 7 or 8 years, the process of unwinding that has begun in the US, and it's going to start now in Europe and elsewhere. So I think that remains a concern. And of course, the risk is that if central banks do too much tightening too soon, it actually cuts off this recovery that we're now seeing. If they leave it too late, inflation then starts to pick up, and they've got a lot to do. At the moment, inflation has remained pretty subdued. But there are concerns that policy missteps could cause some damage to markets in coming months. So there are some risks out there, and it wouldn't surprise us after this long period of sort of low volatility in markets, good market conditions, if you get some setback to markets. But this recovery looks to us to be sustainable. This pickup in growth we're seeing is not to levels which are causing any excess anywhere. Inflation remains remarkably subdued. We've seen probably the end of the deflationary era. We're moving into reflation, but very gradually, having no impact on inflation for quite some period ahead. So central banks can afford to be very slow, very gradual in their moves. And the moves that have taken place to date, primarily by the Fed, have not really disturbed markets too much at all. In fact, markets have continued to move ahead, even as the Fed has tightened policy. So we think this cycle has got quite a bit further to run. It looks sustainable, it's backed by good fundamentals, and if we do get these bouts of weakness in risk assets, we would use that as an opportunity to top up our positions.